On the 4th of August, a company that had publicly promised to hold every single Bitcoin it ever mined handed 18,750 of them to two lenders as collateral. 18,750. About $1.2 billion of Bitcoin. 53% of everything they had left. And in the filing where they disclose it, there is one number that is missing. It's the number that decides whether those coins ever come back. It is not in the filing, not in the press release, not on the earnings call. Their own shareholders can't find it. Almost nobody has noticed what they bought with the money. It wasn't more Bitcoin. It was a natural gas power plant on 1,600 acres in Hannibal, Ohio. A company built to accumulate Bitcoin sold a third of its Bitcoin, pledged half of what was left, and used the money to buy a power plant. And once you understand why a power plant is worth more to them than Bitcoin is, you will understand exactly what is happening to your electric bill. Because it turns out the two are the same story. The company is Mara Holdings. You might remember them as Marathon Digital. For years, they were one of the largest Bitcoin miners on Earth, and they were loud about it. July 25th, 2024. Mara announces it is buying $100 million of Bitcoin on the open market and adopting what it called a full HODL strategy, meaning every coin we mine, we keep. We don't sell. Not into strength, not into weakness. Their chairman and CEO, Fred Thiel, said this, and I'm quoting the press release directly. Adopting a full HODL strategy reflects our confidence in the long-term value of Bitcoin. Confidence in the long-term value. Those are his words on the company's own website, and they're still up there today. I found this the way I find most of these. I keep a dashboard open with the macro numbers on it, and the household cost numbers sitting right next to the asset numbers, because that's where the story usually is. I'll show you what it does with your own figures in a bit. Here's what happened next, and the numbers are not close. At the end of December, Mara held 53,822 Bitcoin. That is the peak. That's the most they ever disclosed holding. 6 months later, June 30th of this year, the most recent audited filing, they held 35,577. That's 18,245 Bitcoin gone in 6 months, a third of the entire treasury. Now here's the line I want you to hold on to because it's the one that isn't in any headline. It's on the cash flow statement, which is where companies keep the truth. Proceeds from the sale of digital assets, first 6 months of this year, $1,627,000,000. Same line, same 6 months, 1 year earlier. 14,252,000. That is not an increase. That is 114 times. And on the line right below it, purchases of digital assets, first 6 months of this year, the number is 0. They didn't buy a single coin. In the same period a year before, they bought $27 million worth. So, 114 times more Bitcoin sold, 0 Bitcoin bought, by the company whose entire investment thesis was that it would never do that. Let me be fair to them for a second, because credibility is the whole product here, and I'm not going to shade this. They sold 23,093 Bitcoin in that stretch for $1.627 billion. Divide it out and you get an average sale price of about $70,400 a coin. Bitcoin today is around 64,000, so they sold above where it sits right now. On pure timing, that sale was not a disaster. If someone tells you Mara panic sold the bottom, they haven't run the arithmetic. That's not the problem. The problem is what the sale means. A company doesn't liquidate a third of the asset it swore it would hold forever because it made a clever trade. It does it because it decided that asset was worth less to it than something else. And I want to know what the something else was. Because whatever they think is worth more than Bitcoin, that's the thing that's about to show up on your bill. In April, Mara agreed to buy a company called Long Ridge Energy and Power for approximately $1.5 billion. Long Ridge is a natural gas power plant in Hannibal, Ohio, sitting in Monroe County on the Ohio River. 485 megawatts of combined cycle gas generation, expected to reach 505 megawatts in the back half of this year. 1,600 contiguous acres, its own fuel supply, water access, and, this is the part that matters, a direct interconnection to PJM, the grid operator for 13 states and the District of Columbia. Mara said the total campus has potential of more than 1 gigawatt. To pay for it, they lined up a $785 million bridge loan from Barclays. They assumed the plant's existing debt at 8.75%, and then on August 4th, they went and got $600 million more by pledging the Bitcoin. $300 million from Coinbase Credit at the federal fund's midpoint plus 3.875%. Call it 7.5% at today's rates. $300 million from 2 Prime Lending at 7.65%, fixed, both due August 2028. The stated use of proceeds, and again I'm quoting the filing, general corporate purposes, including funding a portion of the cash consideration for the Long Ridge acquisition. There it is in black and white. The Bitcoin was pledged to buy the power plant. Now, what's the power plant for? Mara has been very clear, and it's worth hearing in their own words. Fred Thiel, same man who told you about his confidence in the long-term value of Bitcoin on the Long Ridge deal. Power is the scarce input in AI. Power is the scarce input in AI. Not chips, not talent, not data. Power. And read how the company describes what the campus will do. It lists the ways it'll make money as, quote, long-term HPC leases, flexible compute operations, including Bitcoin mining, and wholesale power generation. Read that list again. Long-term AI leases first, selling power to the grid last. And Bitcoin mining, the entire reason this company exists, is a subordinate clause in the middle of a sentence. Not a business, a clause. When your founding purpose gets demoted to a subordinate clause, the relationship has changed. Somebody just hasn't told the shareholders yet. They're not hiding it, they're announcing it. The AI campus construction starts in the first half of next year and is targeted to be ready for service by the middle of 2028. Here's the part that should stop you. On August 7th, 4 days after Mara pledged $1.2 billion of Bitcoin to fund this, Bernstein published a note on the company. Their analyst, Gautam Chugani, pointed out that Mara is still waiting for its first commercial AI contract. Not its best contract, its first. They have not signed one. A competitor, CleanSpark, has already signed AI leases worth $6.6 billion. So let's line that up honestly. Mara pledged 53% of its remaining Bitcoin to build an AI campus that has, as of this week, 0 AI tenants. Bernstein has them at market perform with a $17 price target. The stock is under 10. They sold the sure thing to fund the maybe. And I'd like to tell you they're being reckless, but I don't actually think they are. I think they've made a cold, rational calculation, and I think it's the most important thing in this entire story. Here is the calculation, and it takes one sentence. A power plant has a meter. Bitcoin doesn't. That's it. That's the whole thing. A meter is a device that converts somebody else's daily life into your revenue. Every time a family in Ohio runs the air conditioning, somebody's meter turns. Every time a data center in Loudoun County spins up a training run, somebody's meter turns. The meter doesn't care about the price of anything. It just counts. And at the end of the month, it produces a bill that a person is legally obligated to pay, in dollars, forever. That is the most beautiful asset in the world if you're a corporation. It is a subscription to other people's existence. And unlike every other subscription in your life, you can't cancel this one on account of wanting the refrigerator to keep going. Bitcoin has no meter. Bitcoin sits there. It doesn't bill anybody. It doesn't produce a monthly statement. It has no customers and no rate case and no regulator you can lobby. It just refuses to be diluted, quietly, 24 hours a day. That's its only trick. It's a magnificent trick, and it is worth everything. But it does not generate a monthly invoice. And Mara needs a monthly invoice. So a company that had $1.2 billion of an asset that can't be printed traded it for an asset that can print a bill. Think about what that actually says. They looked at Bitcoin, 21 million, fixed, the only money on earth that nobody can make more of. And they said, we'd rather have the meter. And this is where it stops being a story about a mining company and starts being a story about your house. Because that meter they bought, there's a decent chance it's already pointed at you. Longridge plugs into PJM. PJM is the grid operator for Ohio, Pennsylvania, New Jersey, Maryland, Virginia, Delaware, West Virginia, Kentucky, Indiana, Michigan, Illinois, North Carolina, Tennessee, and DC. If you live in any of those, this next part is about your money specifically. If you don't, hold on, because your grid operator is watching PJM to see what it can get away with. PJM runs something called a capacity auction. Here's what it is in plain English. It's a retainer. The grid pays power plants a fee just to promise they'll be available on the hottest day of the year. It's like paying a plumber a monthly fee to guarantee he picks up the phone when a pipe bursts. You're not paying for work, you're paying for the promise. And you pay it. It's baked into your delivery charge. You've never seen it itemized because it isn't itemized. 4 auctions ago, that retainer cleared at $28.92 per megawatt day. The most recent auction, results announced July 14th of this year, cleared at $325. Now I want to be careful here, because PJM will tell you, correctly, that they changed some of the accounting in between, so that jump isn't a clean apples-to-apples comparison. Fine, so let's not use my arithmetic, let's use theirs. PJM has an independent market monitor. It's a watchdog firm called Monitoring Analytics, and its job is to check PJM's homework. They ran the auctions again with the data center demand stripped out of the forecast to see what the retainer would have cost without it. Here is what they published, exact to the dollar. The total increase in costs to other PJM customers as a result of data center load across 3 auctions was $23,100,955,341. $23.1 billion. Not a projection, not an advocacy group's estimate. The grid's own auditor, in a published report with the arithmetic attached. And then in July, Joseph Bowring, who runs Monitoring Analytics, told Utility Dive that the newest auction added another $6.3 billion, 38% of the whole thing, and that across the last 4 auctions, data centers account for $29.4 billion out of $63.6 billion in total capacity charges. 46%. Nearly half of what every household in 13 states pays to keep the lights guaranteed on is now attributable to data centers. Bowring's own assessment of the grid operator. PJM is continuing to act like it's business as usual. It is really a paradigm shift. And here's the detail underneath it. That most recent option cleared at $325, and that was the legal maximum. There's a price cap. It hit the cap for the 3rd auction in a row. The price physically could not go higher because a settlement agreement wouldn't let it. And even at the maximum allowable price, the auction came up 6,831 megawatts short of what the grid says it needs to be reliable. So, record prices, pinned at the ceiling, 3 years running, and it still didn't buy enough electricity. That is not a market clearing. That is a market failing at full volume. What does that mean for your money? It means the retainer on your bill is at its legal maximum, and the thing you're paying the retainer for isn't there. The retainer isn't the only line, there's also the wires. When a data center shows up, somebody has to build transmission to reach it. New lines, new substations, new steel in the ground. That costs money, and there's a question that gets settled in a rate case that nobody attends. Who pays for it? The Union of Concerned Scientists went through the utility filings across 7 PJM states. In 2024 alone, they found 130 local transmission projects approved, built solely to connect data centers, costing $4,356 million. Over 95% of that was passed to ratepayers, not to the data centers, to you. Ohio's share? 37 projects, $1,299 million. Second highest of any state in the region, behind only Virginia. $1.3 billion of wire in 1 year in one state so that data centers could plug in. And it landed on the bills of people who will never own a server. Then PJM's board approved $11.8 billion of new transmission in February. The year before that, it was $5.9 billion. It doubled in 12 months. The single largest project is $4.8 billion to push 3,000 megawatts into Loudoun County, Virginia, which is the densest concentration of data centers on the planet. Transmission costs get recovered from ratepayers. That's how it works. That's how it has always worked. And now the worst part, which is the one almost nobody has worked out. You are not just paying for data centers that exist. You are paying for data centers that don't. The capacity auction prices off a forecast. Utilities tell PJM how much load is coming. PJM builds that into the demand curve, and the price rises to match. So the forecast itself moves the price. The prediction creates the bill. Imagine your town set the water rates based on how many houses developers said they were going to build. Then imagine most of them never broke ground, and your rate never came back down. That's the mechanism. We know it's happening because AEP Ohio ran the experiment by accident. AEP Ohio had a data center pipeline of roughly 30,000 megawatts, 30 gigawatts of announced demand. Then Ohio regulators approved a tariff that made data centers actually commit, sign a contract, pay for at least 85% of the capacity they reserved, whether they used it or not, for a term of years with an exit fee. Once real money was on the line, the pipeline collapsed. About 13,000 megawatts were willing to pay for an engineering study, and the amount that actually signed contracts? 5,642 megawatts. 30,000 became 5,600. More than 4/5 of it evaporated the instant somebody had to sign something. Which tells you what the cheapest thing to build in America currently is. It's a press release about a data center. And for scale, so you know what's still real, AEP Ohio's entire historic peak demand, every home, every hospital, every factory, every streetlight in its territory combined, is somewhere between 8,000 and 10,500 megawatts. The data center load that survived the contract test is over half the size of everything else that utility serves, combined. So the honest version is, a lot of the announced demand was vapor, and the vapor was priced into a capacity auction, and the auction priced into your delivery charge, and the delivery charge came out of your checking account. Retroactively refunding vapor is not a thing that happens. That gap between what your bill actually costs you per year and what you think it costs you is one of the numbers my macro command center at timtalksfinance.com/members works out for you in about 2 minutes. What does this cost a real person? New Jersey's own utility board approved residential increases of 17 to 20% and named the PJM capacity auction as the main driver, between $22 and $28 a month per household, depending on the utility. An analysis for Maryland's Office of People's Counsel put it between $4 and $18 a month there, with Potomac Edison customers taking a 24% hit. For a retired man on a fixed income, $28 a month is $336 a year that used to be his and now isn't. It didn't come from a tax vote. Nobody campaigned on it. It arrived as a slightly larger number on a page he doesn't read closely because there's nothing on it he can argue with. And that is what a meter does. That is the asset Mara sold its Bitcoin to buy. Which brings us back to the 18,750 coins and the number I told you was missing. When you take out a mortgage, you know the terms. You know the payment, you know the rate, and you know precisely what happens if you miss it. Because it's written down, and it's written down because somebody made them write it down. Mara pledged 18,750 Bitcoin. So the obvious question is, at what Bitcoin price does the lender take them? Every secured loan has that trigger. A maintenance ratio, a margin call threshold, a cure period, a liquidation formula. It exists. It's in the loan agreement. Somebody at Coinbase Credit and somebody at 2 Prime know that number precisely. It is not disclosed. Not in the quarterly filing, not in the subsequent events note where they announce the pledge, not in an exhibit. The filing tells you the principal. It tells you the rates, 7.5% and 7.65. It tells you the maturities. It tells you the collateral is approximately 18,750 Bitcoin, worth about $1.2 billion. It does not tell you the price at which those coins stop being Mara's. So nobody outside the company can calculate it. Not you, not me, not the shareholders who own the thing. You can do what I did. 600 million against 1.2 billion is a 50% loan to value. And if you count the total facility, including the refinance line, it's about 62.5%. But those are my arithmetic on disclosed figures, not the covenant. The covenant is private. And Bitcoin is already down about 50% from its high last October. I'm not going to tell you those coins get liquidated because I don't know, and neither does anybody else outside that building. That's not me being careful. That's the actual, literal situation. And it's the point. Here's the thing to see, and it's bigger than one company. That Bitcoin is not Bitcoin anymore. Not in the way that matters. 18,750 coins are sitting in a lender's arrangement, subject to a trigger written by somebody else, and Mara's control over them ends at a price nobody will tell you. The protocol didn't change. 21 million is still 21 million. Every one of those coins still exists exactly as it did. What changed is that a man now stands between Mara and its Bitcoin. And that is the whole lesson of this entire story. And it repeats at every single layer of it. The power plant has a rate case. A commission decides what it earns. The transmission line has a formula rate. A regulator decides who pays. The capacity auction has a price cap. A settlement agreement decides the maximum. The convertible notes have conversion prices between $18 and $76 on a stock trading under 10, which means they aren't equity, they're debt, and a maturity date decides when that comes due. The load forecast has a utility that decides what to submit. The dollar itself has a committee that decides how many more to make. Every single asset in this story has a man who decides, and they sold the one that doesn't. I want to be precise about what I'm saying, because this is the part people get wrong in both directions. I'm not saying Mara is a fraud. I'm not saying the plant is a bad asset. 485 megawatts with its own fuel supply and a grid connection is a genuinely valuable thing, which is exactly why it can bill you. And I'm not telling you what Bitcoin is going to do next week, because I don't know, and nobody selling you a number does either. I'm saying something narrower, and I think more useful. Everything they are building, the tokenized funds, the AI campuses, the stablecoins, the power contracts, the whole digital reorganization of everything you own, runs on assets with an issuer. A tokenized bond has an issuer. A tokenized house has a registry and a tax lien. A stablecoin has a company that can freeze it. A power contract has a commission. A dollar has a printer. Every exit they will offer you over the next decade has an owner. Every one. Bitcoin has 21 million. Fixed. Forever. No servers, only a protocol. There is no board, no rate case, no committee, no forecast to submit, and nobody to petition for more. Not because someone promised, because there's no mechanism to do it. And notice what Mara's own behavior proves rather than disproves. They didn't sell their Bitcoin because it broke. They sold it because it was the only thing on their balance sheet that could be turned into cash without asking anybody's permission. It was the most liquid, least encumbered, most genuinely theirs asset they owned. That's why it went first. That's not an argument against Bitcoin. That's the argument for it, told by an accountant. Now, the guardrail on all of this, and I say it every time because it matters, there are no certainties, only probabilities. Roughly 900 trillion to a quadrillion dollars sits in the world's store of value assets: gold, bonds, equities, real estate, cash. As that repricing moves on to digital rails over the coming decade, if 15 to 22% of it migrates to the one asset that cannot be diluted, the arithmetic puts a single Bitcoin somewhere between $7 and $10 million. Fidelity's own model, more conservatively, has it around a million by 2030. Those are probabilities, not promises. It might be less. It might be nothing. That is a legitimate answer, and I'm not going to pretend otherwise. But run the other side of the trade. What's the probability that the men who set your capacity price, your transmission rate, your forecast, and the number of dollars in existence all decide simultaneously and voluntarily to stop, to leave your purchasing power alone? You already know that answer. You've watched them for 50 years. And one more thing, because Mara handed us the demonstration for free. There is a difference between owning Bitcoin and holding it. 18,750 coins in a lender's arrangement, governed by a trigger you can't see, are not the same as coins you hold yourself. The protocol has no issuer. The paperwork wrapped around it absolutely does. I'm not telling you to do anything. I'm telling you what a company that promised to hold Bitcoin forever did the moment it needed a meter, and what it cost the people whose bills pay for that meter. Do with it what you like. You've got the same math I do now. If you want to see what this is actually costing you rather than guessing at it, I built a thing for that. Free, no credit card, about 2 minutes. Take the money quiz at timtalksfinance.com/members. It'll show you your net worth in one place, what inflation and rising household costs are quietly pulling out of your savings every year in real dollars, and one move worth considering for your situation. Not generic advice, yours. I built it because I got tired of doing this arithmetic on a legal pad, and I figured you might be too. Thanks for staying with me. I'll see you in the next one.